Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Yeah, how you going? Good to see you.
Good to see you too, man.
So we'll do the usual spiel, which is that people that are listening or watching this can get a hold of us on Twitter. I'm at Owen Rask, and Anirban is at A Mahanti. Is that correct, mate?
I keep forgetting my own. It's at 7A Mahanti.
At 7A Mahanti. That's right. Because obviously Anirban is covering global companies each and every day that he is working. And what have you been working on lately? Normally we just kind of talk about anything that we've been working on, things that we're producing. A lot of tech companies out in the US, so we'll be talking about them. But anything in particular that's caught your eye or that you're working on behind the scenes?
You know what I'm I can do a little teaser. So I'm working on our August recommendations, or my August recommendation, which of course I'm not going to name, but yeah, I'm very excited about this one because I think it's again small cap style company for US or mid cap maybe, depending upon your definition, but really fast growth, really juicy margins and things like that. So yeah, I'm excited about it, and it's an interesting one that I had a lot of fun actually digging into. So that's what I've been working on.
When you say small cap by US standards, like, can you give us a band? Is that less than 50 billion? Is it less than 20 billion? Like, give us a bit more of a tease.
Definition. Yeah, I'll give you a bit more. So the standard definition that has been used for many, many years in the US or globally is that between 2 and 10 billion is small. Or a mid cap maybe, and below 2 billion is small cap, and then anything above 10 billion is pretty much regarded as large cap, and then maybe 100 billion plus market cap has been regarded as mega cap, right? Now the thing I'd like to remind people is, if you think about the S&P 500 as the index, and that index has basically the index marches, index looks like a straight line going up, right? To the right over the long term, right? If you just you remove the blips along the way that are there for various recessions and pullbacks and things like that. But over 30 years, the S&P has probably gone up. I don't know. Again, I'm making up the numbers, but I know the number for 30 years ago. 30 years ago, the average S&P 500 company probably was about 7-8 billion, something like that, market cap. That is now the average S&P 500 company on average is about a 60 or 70 billion. So there's a 10x kind of, but like maybe somewhere, maybe not be exactly 10x, but several orders of several multiples, 5 or 6 or 7, something like that. Without I have a tweet about this, but I don't have the data on the top of my head. But my point is that if the definition for what was small and mid and mega cap or large cap was made 30 years ago, we should probably adjust for the fact that over time markets become larger, right? Markets grow, and if you expect the market to grow, you should also expect that companies become larger over time by definition, and therefore, and the very fact that companies take longer to go public, right? So it makes sense to sort of adjust the definition. So, yeah.
I was going to say, some of the companies that we're talking about today are measured in trillions. So, so if a mega cap is 100 billion, what is a trillion?
I don't know, Krypton cap or something like that. Kryptonite cap.
Yeah, and it's really interesting because a lot of companies are racing towards that $1 trillion mark. I remember when I think Apple did get there first, although I could be mistaken on the exact timing. But I remember when Apple got to $1 trillion, everyone thought, it's already $1 trillion. I cannot get bigger from here. And I thought that was really interesting because I feel like that's just a number that is kind of, in my mind, it's in and of itself, it lacks context, and therefore it's probably meaningless. Like if you think, well, okay, but then how do you relate that to the addressable opportunity and the growth and, just all of these different things, these different metrics, and you have to put it in context to make sense of it, because it's like that large number bias, right? As soon as the numbers get big, we kind of shy away from them for one reason or another. But anyway, that's really interesting. Yeah, cool. So you're working on the recommendations for 7 Investing. What's the schedule? Is it the first of the month? Is that when it comes out?
Yeah. So the first of the month before market open, basically the recommendations come out, probably around 7, maybe around 8 o'clock or 9 o'clock, typically, depending upon your time zone in the US, the recommendation would come out, but it comes out before market open in the US.
Yeah, right.
On the 1st of August, which would be for us, I guess, it would be the second here, right?
Yeah.
So it would be the second sort of morning, or second, or first late night or second morning, depending upon when you look at them.
Yeah, fascinating. I love that 7 Investing is always so prescriptive. The team and yourself just have like a schedule and people know what to expect. I think that's really good because it's kind of transparent in terms of what you get with the subscription, but also for the advisors like yourself who have to come up with these ideas, it kind of sets a deadline. And it kind of forces you to flex that muscle. So today, we've got a few companies to get through, mate, and a couple of them are very, very, how shall we say, in our sweet spot, companies that we love to talk about. So we probably should put a cap on ourselves. And given that the first one is one that we've already talked about on the show, and is super popular, talk about racing towards $1 trillion market cap, which is Tesla. Take us through the latest, mate, results, anything that's caught your eye, and just generally, what do you think?
Yeah, well, Tesla's results, I would say, were phenomenal. And,
of course.
And I don't know. I don't know whether we should try this or not. Should I try even to share my screen? That would be something. Maybe we can try that. Hey, let's try a share screen as well. Host has disabled participant share screen. Okay.
That'd be right. I knew. I knew it was coming up, and I thought, you know what?
I thought, let me disable it.
But okay, you should be right to go. And for those of you that are just listening to this, we're actually trying to do a Zoom recording, so this is our first attempt.
Okay. So let's try that. Let's go. Sure.
Okay, here we go.
Can you see my screen?
Yes, I've got
you can see my screen. And you got. So I just want to talk very quickly about this one. And I want to talk about the first line. If you look at the automotive revenue, and you look at the, there's a pink shaded Q2 2021, and look at the year over year. Okay, so this is a company that printed $9 billion of automotive revenue. That revenue, $9 billion in one quarter, was up 97%. Okay. I love my small caps when they grow like this. It's my common refrain. And then you look at the margin expansion, look at the gross margin there. So the margin is 28.4%, up from 25.4%. Look at that expansion in the margin. This is phenomenal. I look at the gross profit line and how it has expanded 120%. Again, I think what they're doing here is basically the gross profit line expanding that quickly or showing that leverage basically suggests that they're doing some really good cost management, which is phenomenal. And then the other thing I want to point out is if you look at the operating operating margins, right? The operating margins are 11%. That's a double over the prior corresponding period of Q2 2020, right? More than a double, a little bit more than a double, which is fantastic.
Even the last quarter, it's almost doubled. Just over quarter on quarter, right?
Quarter on quarter. It's just phenomenal, the execution here. And then look at the, if you look at the GAAP profit, the net income profit, this is one of the lines that the bears love looking at and complaining about. So the net profit, net income line, if you look at it, I've got it here highlighted, 1.1 billion, or if you want to look at the non-GAAP number, 1.6, but let's look at the GAAP number, it's 1.1 up. One of the favorite things for the bears is to look at that and subtract out regulatory credits, which is 354 million. Well, still profitable, which I find is fascinating for the company. I think this was a brilliant quarter for them. And, one of the things that I tweeted out, so I'll try to stop sharing if I could figure out that. Oh, yeah, here we go. Stop sharing. stop sharing. Okay. Cool. And the only other thing I want to talk about here is a few things that they had. Everybody's hit by this chip shortage. What they did is they basically substituted, went to a different chip, wrote the new firmware, firmware required for that chip. So there are a lot of quick thinking on the feet. A couple of other points to note. They didn't have any advantage from the Model S and X that they've refreshed yet in this quarter. In fact, it was actually a negative gross margin for them this quarter. That should only add to their gross margin going forward. Now China is their exclusive export hub. Model Y is going to be launching has already launched in China and is going to be launching in Texas and in Berlin. Model Y is likely to be even more popular than the Model 3. So this company is in a really strong position. A couple other things quickly to think about. They've launched an FSD subscription for the sort of the full self-driving suite, just to make it more palatable and easier for people to subscribe. So that they're trying to get this the services revenue to roll. I think still very early days there. And the final thing, which I think is very interesting, is that they're looking to actually open up their supercharging network to non-Tesla cars. This sounds counterintuitive, but this is very, very interesting because saying it's a question of having adapters in North America, and actually you don't need adapters across North America because they're actually the same adapters. But you have the adapters, I think, and then the question would be, well, already you have wait times for Tesla cars trying to sometimes in some busy areas to actually use the supercharger. But one of the ways to expand supercharger is to actually make money off it, right? And this is, one of the best charging infrastructures that exist for electric vehicles is Tesla's. So Tesla is saying, well, we can expand our infrastructure really rapidly by opening it up to others to use. We can make money off it. And the way you would use it is via a Tesla app, right? That's bringing those customers one step closer to the Tesla experience, right? So, it could be that they are already an EV customer. Maybe they have a Ford EV, and the next time they want to buy something or trade in, and they'll probably think, oh well, why shouldn't I, consider having a Tesla instead of having a Ford? So I think it's very interesting. They're presenting it as doing stuff for sustainable transport, but I think there is some business motive here. I think it's like a Trojan horse type of approach. Fine, we'll let you do it. Let's see what happens, and we'll make money off you. We'll expand our charging network at a rapid pace. Then people will realize, and people will meet other Tesla owners at these charging stations and probably interact and see how cool the Tesla vehicles are. And then, that's basically sales and marketing, Elon Musk style. Finally, last bit, and then I'll stop. Elon Musk said he's no longer going to be on the conference calls. I think this is a brilliant move because he just rambles on the, conference calls are for analysts who want to plug in numbers into their spreadsheets or their models. And he does a really, he hates those boneheaded, tell me what I need to put in my model questions. But Zach Kirkhorn, who's the CFO, he actually does a really, really good job of, explaining things properly, and doing it in a sophisticated way instead of telling, that's a stupid question. Don't ask me stupid stuff. Move on, right? Kirkhorn is not going to do that. So he said, he's going to, come to the annual meeting, be there, but not be on the conference calls. I think this is a net positive. Jeff Bezos never goes to his earnings calls, which is great. And many people don't. Steve Jobs never did. So yeah, it's he's probably.
How long do you reckon the CEOs and executives spend preparing for a quarterly update?
Well, I bet some people do, and I bet some people like Elon Musk just show up. Like, okay.
Yeah.
Right.
Yeah.
But I bet some people do. Some people take this very, and again, some people probably take it very seriously in the sense that that it is one of their jobs, right? I mean, one of the things that they have to do is to communicate what they're doing with the company, how the company is performing. So, I mean, it can be both ways, as how much time should you be spending should come naturally to you. Are you trying to, pump up the stock or not, and things like that. But yeah, I think some people do, some people don't.
You said something when you were talking about Tesla there at the beginning, which was about creating the firmware to sit on the chips. Who creates their chips? Who produces them?
Yeah, so the lot of the chips that they were talking about were the chips that have been in short supply have been the seat belt. Seat belt has not been put in that, the sensor for that, right? Or the airbag sensor. Those have been the ones that have been hard to get. So suppose you were using that sensor from, supplier X, and you had a firmware that works for that supplier X, but that supplier X can't give it to you, but you can get something from supplier Y. Now you can use supplier Y provided you can write the code that works for that particular chip, right? So multiple, there are hundreds and there are probably like 10,000 suppliers involved in making an automotive, a car, right? Or various parts of the supply chain. If you think about all the little things that are in, from the bulbs to, the plastic to the, the seat belt components and things like that. So yeah. So, I mean, it could be anybody.
Really. Yeah, because that's a good, I guess, segue into the next company, which is Apple. So just some high level numbers. Total revenue up 36% to 81 billion, which is huge, massive. For a company at this size, it's just unreal. iPhone sales jumped 50%, which caught me off guard when we were doing just running over our modeling briefly, Catherine and I, before I jumped on the call. To $39.6 billion for the quarter. Mac sales up 16% to $8.2 billion. iPad sales up 11% to 7.4. Wearables, home and accessories up 36% to 8.8 billion. And services revenue, a huge 33% increase. And I mean, it's hard to look at those numbers and think that this like defines something negative. I mean, I was trying to think about it because this, as we record this, the stock is down 2% after hours. And I don't glean much from market moves. I just find it interesting, like fascinating how markets react, really. I don't ever make a decision, but I just thought it was interesting. And the only thing that I could think of that people weren't happy with were probably that they weren't able to provide guidance yet again, and which they haven't done for a while. And also, they cited the chip shortage, because in the past, Apple has said, we're managing it, we're growing, et cetera, et cetera. But I wonder, my takeaway from the quarter was basically, I think they maybe even underestimated how fast they've grown and how much they've had to fulfill in terms of, you think of all these people working from home, learning from home, everyone's getting an iPad, schools are getting iPads. Then everyone wants an M1, MacBook. I want one. I definitely want one. We actually had put in an order today. So, we want iMacs. Everything's coming out now. And then on top of that, we've got this 5G super cycle, the rollout of 5G, the iPhone 12, which is huge. And particularly in China, the sales in China are up 58%. And I guess when we were looking at our model, mate, we jumped into it just before. And it was actually funny because we drastically underestimated iPhone. I think it was interesting because when we did our modeling, we did it in October 2020. That was the last time we did the proper update for our model. We tend to do them every quarter. We tinker with them, but normally once a year, we'll go back and really dig into it again. And when we did it, I think this is kind of that recency bias, right? Where you're in COVID and you're forecasting during COVID, you're not fully aware of kind of the bigger picture. And it's probably, an issue on our end, but fortunately we still thought it was undervalued, even though we had very conservative estimates, and it's come out and beat that. Gross margins up because of services revenue, subscriptions up to 700 million. This is a business with over 1 billion iPhones in circulation, lots of upgrading, lots of switching going on. I just feel like it's at this time, it's almost like there's no end in sight. Maybe, I was hoping to actually ask you a technical question, if you don't mind, which is around, and I was trying to explain this to the guys earlier on, which is around why the iOS architecture, so basically the operating system and how it runs, is actually superior to other architectures. Do you have any insights to share there?
Yeah, so I mean, I wouldn't call the architecture, like if you think of the operating system as such. So all of these, the iOS and Mac, they have their roots in sort of in the BSD Berkeley Unix system, right? So that has really stood the test of time, right? So in terms of the core architecture value. I think that and I wouldn't say that the Android OS is inferior. I'd say it's great. I think the reason I think iOS works really well is the very tight coupling between hardware and software, right?
Yeah.
So like, for example, the way the secure kernel works, you can't make that, like, by basically saying that certain code can only execute in this particular chip in this particular way. That's hard to do if you write, code that is kind of like open sourced, and then everybody else is porting it and then making it work for them, right? Because the underlying architectures then is different. So because of the tight hardware software integration, they can do certain things that are harder to do otherwise, right? And then the other thing that really works well for iOS, and this is underappreciated, is and this is an attack point, right? So the walled garden approach. The walled garden approach is they don't approve every app, and you can't sideload, right? So you can't sideload as in you can't basically download an executable and run it on your iPhone without jailbreaking it, right? And what that does is every app basically is approved, which means malware entry is really, really hard. Like, you really have to be a sophisticated malware, developer to, for you to evade Apple's malware detection. Then, because, the way things would otherwise happen is that, somebody would download something, they would share it, that would cause somebody to share something with somebody else, and then it kind of spreads, right? So I think those decisions, so these are, I would say, design decisions to some, systems decisions combined with design decisions that have made it what it is. So that would be my view on sort of the architecture as a whole.
That's what I mean. If you look, say, with the new M1 chip, right? And we have a lot of Adobe users here, and so it's a company we've recommended before, Adobe. It's brilliant business, but even almost every creative has an iMac or a MacBook, right? Because it looks good. Like you said, it actually looks good. So aesthetically, it's better, but it also tends to run really well with essential software, particularly with like the GPU and whatever. And basically, when the M1 came out, Adobe was kind of scrambling to make sure that they could meet the standards, because they knew a lot of their users would be upgrading to new Macs, which in turn meant that their software had to run on that. And Apple has its own program, Final Cut Pro, which is an audio-visual editing software as opposed to Premiere from Adobe. And it's interesting just to see how the different pieces of software run, right? Like, everything's really fluid on an iOS device because it's native. And I think that's underestimated. I personally think that when you look at the services revenue of the business and just the way that you interact with an iOS device, I think that is going to become more pronounced over time. I think that ecosystem is getting stronger as time goes on, like far stronger than people realize. And that's basically the basis for us forecasting much stronger services revenue growth into the future, because, the saying, once you go Mac, you never go back. And I think in this instance, these are great results. I don't expect them to keep chalking up this type of growth, but in short, very, very happy with it. Another company, mate, which we want to just touch briefly, is Microsoft. So people will know Microsoft at another operating system business, but also Azure Cloud Compute, Xbox, Windows, Office 365, LinkedIn. It's got so many things under its hood. I think it owns GitHub now, if I'm not mistaken. You might know that. Yeah. So many things under its hood. Just top line revenue growth of 21%, $46 billion, operating income of $19 billion, up 42%, net income $16.5 billion, up 47%, EPS $2.17, up 49%. So fascinating. Satya basically put it down to cloud adoption, the whole stack basically of 365 and Azure just driving home growth. It's as simple as that. I often think, mate, when I dial into one of these calls, these investor calls, I just think, like, as an analyst, I just think these are just such impressive businesses, just behemoths. It's almost like you can't stop them. I'm trying to find a reason not to own them, and it's very, very difficult. I don't know. That's just my big takeaway from tuning into these calls.
Yeah, I think what I'll say is that one thing that has happened during, I guess, during the pandemic is it has sort of further strengthened these businesses, right? Because, I mean, they're basically, if you look at, for example, Apple's growth in China, right? There have been so many new entrants to the Apple ecosystem, right? They're quoting some numbers like the 85% of the Apple Watch, sales in China, for example, were new Apple
which is
Watch.
huge.
Which is huge, right? Because once you
Huge.
enter the ecosystem, you're going to
You
use
are
something
in.
else.
Yeah.
You are in, and it's just so in many ways, it's very interesting because Apple is a tools company, right? It provides tools and services. It wants to get out of the way, be in the background. Yes, it wants it to be look beautiful, but it wants to provide something that gets jobs done, right? And people needed these things. People needed to exercise. People needed to monitor their blood oxygen level, right? I think the blood oxygen level, in the ability to measure that, it was pretty interesting because it was, during the COVID times, and you needed to know that if blood oxygen level fell, well, you probably have a problem. So I think all of those things are, just an indication of the promise and power of these businesses going forward. And, consumers love them, right? I mean, whether it's Microsoft or Apple, if you love your Xbox, you love it. That's what it is. And if you're on Azure, you're on Azure, and you're going to not unlikely to churn out of it, right? I mean, so many healthcare businesses, for example, are on Azure. And same thing with Microsoft Exchange. If you're using Microsoft Exchange, well, it's unlikely you're going to switch out of it. Or if you're on Office 360, are you going to get out of it? Probably not. So I think, again, extremely sticky. And, I guess what is surprising is they were already pretty powerful and, well embedded, well entrenched. They became further well entrenched. And it would probably not be surprising to see them becoming even more well entrenched, right, as more and more people go digital.
I don't know if Tesla was included in this list, but I read an article from CNBC, I think it was this morning, and basically that the big tech companies that are reporting this week account for around about 18%, I think it was, of the S&P 500 in terms of market cap or something like that. And these are businesses that are growing so fast and still just getting more and more valuable. I was saying to Kevin, our analyst here, before that, regulation is probably the big risk, right? Whereas in the past, we talk about oil and gas companies, we talk about, in times gone by, there'd be rail companies, all these different things, right? Nowadays, you talk about Google and you say how powerful it is and how profitable it is, which is one of the companies we're going to get to next. But then you think about even Microsoft, Apple, Tesla, all these companies, the way they communicate, it's not, people don't hate them for making money, which is interesting. And they can also kind of intercept the news flow, right? So they can have an influence at a scale that's probably never was 20, 30 years ago, was never thought of. So it's a fascinating thing. Speaking of, I'll maybe, because we've talked a fair bit about this stuff, I'll maybe go over Google pretty quick, aka Alphabet. So just some higher level numbers. I think I've got them in front of me here. Yeah, so here we go. Obviously, just incredible growth yet again, 62% change in revenues year over year to $62 billion. And popping the hood on that, of that 62 billion, 36 is Google search, 7 billion from YouTube, which I believe was up over 80% year on year. The Google network, other like so websites and that type of stuff, 7.6 billion in revenue, up from 4.7. Google other, 6.6 billion, up from 5.1. So that includes hardware and things like that. We've got Google Cloud, which includes, for those of you who are on it like we are, Gmail, Workspace. It also includes their public cloud computing layer, which is GCP. That rose from $3 billion to 4.6. And Ruth Porat, who is the CFO, said that that's where they're spending a lot of their money. That's where they're recruiting into engineering and product, spending a lot of their focus. So maybe a lot of people don't know this, but basically under the hood, while those numbers sound fantastic, those businesses are still scaling. Each of those segments, with the exception of search and advertising, which is their core, Google advertising business as you know it, the others aren't profitable at the operating income level. So no profits there at all. Basically using the huge margins from search to plow back into the other business lines. I really like Google. You know what was interesting, mate? I was sitting, it's early morning here in Australia when you're when you're tuning into the live call. I think it was around about 6:30 a.m. our time. I got up a little bit earlier this morning and listened to the last quarter's call before this quarter's call, just to refresh my mind and also just get familiar with what management were talking about last quarter. And I listened to them back to back. And I thought this is just a bit of a quirky thing. You talked about dud questions from analysts. And not that it was a dud question, but I actually find it interesting that the same investment bank and the same analysts asked the same questions in the same order as last quarter. And they asked them to the same people in the executive team, which I thought was very, very interesting. And I thought, surely this is a plant, like surely something's going on here. And I was trying to think for myself, why do they, like, is this some sort of political game, like argy-bargy, like who gets to ask the first question? I feel like it must be on these analyst calls. I don't know.
I thought on the analyst calls, you have to basically do *1 and get into the queue, right? And maybe there's like a, race to be the first one to ask the first questions and whatnot. But yeah, that's pretty funny.
Yeah, this one, in this instance, it was Morgan Stanley. But I just find it funny because I feel like I've heard stories of companies, you have the operator that kind of sits between the company and the people calling in. I've heard stories in the past of companies actually blocking questions from certain analysts or from certain places. Not saying that this happening in this situation. I don't think it's necessary like, just everyone line up and get in order and whoever's, first come, first serve. I feel like there might be a little bit of kind of, picking from the crowd who they want to get the questions from. But like you said, I think you can get it a lot from things outside of analyst calls, right? Like, developer conferences, product roadshows, those types of things. I think those for these companies are probably more valuable than the quarterly calls because they're all interested in the next quarter. And as long-term investors, most of us listening to this, we don't really need to think about that too much. How about, mate, we've talked about chips and that type of stuff. How about closer to home here in Australia? Has anything come across your desk that you found interesting?
No, well, I haven't really looked very carefully, other than what I saw. I saw that Temple Webster had some really strong results, and that's and I also read that they had some issues with logistics in terms of shipping, which everybody else is having. But that's the only one that I have seen in terms of sort of results or reports, 4Cs and things like that. I haven't actually looked very carefully of late recently, but I'm willing to hear what you have seen.
Yeah, well, I was just glancing over the Temple Webster thing. So for those of you who don't know, Temple Webster is an online homewares and furniture retailer. So revenue up 85% year on year to 326 million. I feel like 2 years ago, I would have thought of Temple Webster to go shopping at, but since COVID, this is a business that's really like, we bought something the other day. We bought a bed frame from Temple Webster. It came on time. Everything was perfect. It was a great price. It's a good product. And I feel like the game has changed for a lot of these e-commerce players. I know we talk about like the COVID kind of pop that companies have kind of got the shot in the arm from COVID pushing everyone online. But I feel like some of these businesses, like there's no reason for me not to shop on Temple Webster for these types of products. So it's a really interesting business. Not one that I own, but in terms of news around the interwebs, probably the one, maybe I'll start with a cheeky one, which came from CommSec. I logged into my account yesterday, and I saw that CommSec, there's a little site news thing at the top of the CommSec homepage. I'm not sure if you've ever been on it, but I never read that stuff. And I just saw that there was a change to the CommSec's interest rates that you get on cash in your account. And because they have the international account, this is the first time I noticed it. I thought, I'll just check it out. And I went in there and I saw the note, and it said between 0.8% and 1% is what you'll be charged to hold your euros in a CommSec account. And I thought this was interesting for some of our investors that do invest internationally. It's obviously not anything new in Europe, but I just thought it was interesting that if you did have euros sitting in your CommSec account, you're paying if every day that your money is sitting there a lot. If you think about your account keeping fee, I don't know, depending on your view on the currency, it might be wise to bring your money back for a little while before you make the decision, because that is pretty taxing for a brokerage account. So I thought that was interesting. That was just a little thing. But the company that I've been doing a little bit of work on lately is a company called Dubber. It's on the ASX. DUB is the ticker code. And so what does it do? It's basically a call recording business. So it records calls coming across carrier networks like Telstra So if you say you work at, I don't know, BHP Billiton and you're a Telstra customer, you might be offered Dubber's software as part of your compliance. So when your executives make a call, that call can be recorded for quality assurance, for all the different stuff that you want to do, but it also can be used in things like customer service. So if you call customers regularly, if you're in the financial services industry, or if you're in an insurance business, you like to have those calls recorded for quality assurance, but also for like advice regulations and all that. And what Dubber's software can do is what they're building out is AI effectively to run over the top of that. And so it does things that like looks for keywords. So it might look for things like, words that associate with being angry or really annoyed or frustrated. Things like if you said frustrated on the call, that would be a negative sentiment indicator, for example. And an alert would pop up and say, this week, it looks like our customers are more negative. So an example of that might be in the airline industry when flights get cancelled. Conversations tend to skew negative. But what some customers tended to do as well during COVID is when they had airline customers is they also gauged the sentiment of their employees who were making these calls and taking these calls. And that's a really powerful insight. And basically the way Dubber works is it rolls out via carriers, well, these partners, but it also is now moving into over the top type products like Zoom, Microsoft Teams, WebEx, these types of things. Like we're on Zoom right now, you can actually go into the Zoom marketplace and find Dubber and have that as an add-on. And so this is an exciting frontier for the business. And the business has been growing really quick, but in short, why did it pop up on my radar this week? Well, it's making $110 million capital raising. And in the context of a 700 mil market cap, yes, it's big, but it doesn't sound that big. But when you compare it to its revenues, it's humongous. And they haven't actually, as far as I know, at the time of recording, they haven't actually decided what they're going to do with it. I think they're raising capital without. They've got this chart in one of their investor presentations, which effectively shows 4 network effects basically layering on top of each other to show exponential growth, I guess. And they've got I think it's $100 million revenue ARR target. And then the business is growing really fast on the top line, but obviously it's got to translate to profits sooner or later. And I think my questions as I do my research are just around that. How does it get the operating leverage? Like we saw with Tesla at the beginning there. It's getting the ARR, the annualized recurring revenue, but where does it go from here? So anyway, that's Dubber. I don't know if you know much about that, but it's an interesting little business.
Yeah, I know a little bit about Dubber. There's a couple of things I'll say about Dubber. One thing to keep an eye on, so is, the analyzed recurring revenue. So let's say you're doing $40 million Australian, growing that, let's say 200%. That's pretty quick, right? Because that can effectively, you could triple very quickly next year, right? To 80 million, if you can maintain that growth. My main thing with if you're investing in a company like Dubber, you're basically taking, in some ways, you're making this bet that they would be able to transition to sort of 100 million plus, and then still continue maintaining, continue and maintain that growth rate. For a subscription business, typically 100 million in revenue is really kind of like a tipping point in many ways, right? So other than that, I think the interesting thing for them is this recording, the ability to record without hardware, right? So this is what they're replacing really is like, so let's say you're Qantas and you had your own IT infrastructure on which you were recording calls and things like that. They must have gotten a bit of a COVID bump as well, right? Because, as people sort of moved to taking calls at home, how do you sort of, route those calls back into your IT infrastructure for recording versus, it's much easier to use something like a Dubber to record into the cloud, right? So I think they must have gotten COVID bump, which is, really, really useful thing to have, because that causes that step change in spending that businesses need to buy and license the software and sort of use it. So I think it's very interesting business at an interesting growth rate. It's always a little bit of a question mark as to when you raise $100 million of capital without really outlining what you intend to do on a 700, 800 million, whatever is the market cap. It's a fair bit of dilution as well. But the share price looks like, it's as close as high as it possibly can in terms of, to do quantitative easing, right? If you want to do quantitative easing, this is when you want to do it. You don't want to do. So I call this this is from my time looking at small caps. this is very common. Actually, it's not even common for small caps. This is quite a common strategy on the ASX, which I call the quantitative easing on the ASX. This is not a small cap only strategy. There are, other companies which regularly do this, and play the arbitrage game. And they've learned it from the reserve banks, which is really cool. But again, I think this business can be profitable, right? Because it's a fairly asset-light business, right? It's a pretty asset-light. You build the software, so some specific costs for running the software, some improvement costs, some storage, cloud costs you've got. There should be operating leverage in this business at scale, and it's growing quickly. So I mean, actually, yeah, I quite like this business.
I do too. For the ASX, I think like the question mark, if you're into valuations, is how much is it worth? Well, when the business is growing this fast, it's a wide range of variables that go into that. So yeah, I just got the doc in front of me here.
20 times, I think it's like what, 18 to 20 times sales, which is very high price to pay.
Yeah, it is. But so the four uses of its capital that's kind of laid out, but it hasn't been concrete. Normally when you see $100 million capital raising, it's to make an acquisition. But they've said here the four things are significant and growing TAM. These are the four layers. Foundation partner program. So they've just had a really interesting deal with WebEx, which they need to expand. They're going to put more solutions into the universe, including investing in its AI and data sets and growing those types of, I guess, just the coding and developer effort there. And then strategic and accretive M&A. They have made two acquisitions in recent times, which one was small, but I think it was Spec in the UK, which is an interesting one. And so there's definitely like some track record there with M&A. It's not necessarily just all for nothing, but an interesting company for your watch list at least. There was another thing before we get maybe to the final thing, which would be two stocks to watch. Last week we talked about COVID. As we record this, Sydney's still in a lockdown. It looks like it's going to be for quite some time. Sorry, mate. Here in Melbourne, first day out, we're out and about. I'm recording from the office. Do you have any updated thoughts to share on this?
Well, again, vaccination is a race, is my only thought. And, it'll help if vaccinations were there. It looks like, I mean, the only thought I would like to put out, and I've been saying this on other calls, is, one of the things that people say, oh, look at all those people with vaccinations who are admitted into hospitals, right? I think there's a little bit of a statistical fallacy going on there. Like if you look at the people who are admitted into hospitals right now in say New South Wales, for example, most of them are unvaccinated, right? And you see a skew towards the younger population because the younger population has not been vaccinated, right? And then you see some people who haven't gotten the vaccine for whatever reason there may be. The other side of the story, though, is that if you have a country with 100% vaccination, then all the admissions are going to be of people who are going to be vaccinated, right? So what you really need to now think about is, well, how many people are admitted and how many people are dying? And so, you compare that with other standards, I guess, of, seasonal viruses. Once people are vaccinated, how does this compare with things like that? So I think that there's a little bit of a nuance here that needs to be understood in terms of just interpreting the numbers. But it looks like UK is okay thus far, and is looking increasingly okay. America is mostly open. Canada has announced, I don't know if you talked about this last week, but Canada has announced that their borders with the US are opening next month, and then the borders to the world are opening the following month. They're at about 80% vaccination. And I think the easiest way to increase vaccine coverage is to actually expand the usage or the range of people who can have it. So if you go from 12 plus age-wise, you've just expanded coverage. We know that children who go to school are carriers, all sorts of things, because they mingle with lots of other friends, and and children have great immunity, so they don't get affected by anything, but they can bring it home, which can then affect someone at home. Then they can give it to somebody else. So. So I'm generally positive about, I'm very positive about what science can do. And I think all the vaccines that are out there are good. Some may be better than the others, but they're all good in terms of what they do, in terms of in terms of preventing, serious health issues, and in terms of preventing death. They're all really, really good vaccines. At least that's what the data suggests. So,
hospitalizations in the UK are still significantly lower than where they were in the past. So even though they're still recording many thousands of cases a day, as you said last week, hospitalizations well down. So I guess that's really good news and great news about Canada too. Yeah, we actually got some feedback on Twitter about this. So that was kind of a rational conversation about COVID and Delta and basically how to invest in it or out of it. If you want to learn more about that and you haven't listened to the latest episode, you can go back a week and listen to our chat then. So finally, actually, there's a little message here that I might read out because it was kind of nice. It's written by Patrick, who's a listener of the show. So, hey guys, loving the new podcast. The focus on stocks and types of stocks and personal views and contrast of ideas is great for an intermediate investor with growth/tech leanings. He's given us a bunch of ideas to run through, such as IPOs, M&A, things like Woolworths and Endeavour, PEXA, LICs, like the Ballador LIC, and Thorny Tech LIC, PPK, which is an upcoming IPO. So this is a great message from Patrick. Patrick, if you're listening, I bet you are. Thanks for writing in. If you want to reach out to us, you can do that via Twitter. It's a great medium to engage and follow along and have a bit of a chat. I think we had some other listeners join us on Twitter during the week and said, you guys are actually talking about everything that you spoke about on the podcast. And yeah, we love it. So come and say good day. So, in closing, if people want to get your recommendations and see which companies you're recommending every month, how can they do that?
Well, go to 7investing.com, /subscribe, use Rask's code, get $10 off to join. And yeah, and how about, how can people join Rask?
Well, yeah, there's like 7 Investing, there's a link in the show notes, so you can head to rask.com.au. So yeah, both of us would love to have you on board either of our respective services. So yeah, you can find out more, on those sites, but you can also just find us on Twitter. We'll have links in the show notes, so you can follow along. Like Patrick did, you can write into us and share your thoughts. We do actually love hearing from you. We're not just hiding behind the camera or the microphone. We love hearing from you. So, and Twitter's just a great place to do that. So, yeah, we look forward to hearing from you. And if you are a bit wondering if you're driving, listening to this, and you're thinking, what were they talking about sharing screens? It's because we're actually doing this via Zoom and we're trying to share a screen with one another and put it onto YouTube. So you'll have to just be patient with us, but hopefully this will go out in video form, or at least the future episodes will. So if you like that format too, if you want us to share our screens, maybe I can come on here in the next few weeks and share some models too. Happy to do that. So mate, as always, a pleasure. Thanks for taking some time to join me.
Pleasure's mine. Thank you.